But let's welcome on board and let's talk about where this market is headed next. We've got Rahul Veera from Nippon India AIF joining in on the show right now. Rahul, hi, good morning. Good to have you on ET now. Rahul, so many moving parts within the globe. Help us analyze where the entire emerging market versus DM trade is actually as of now.
See, if you see for the past 1 week, right, your dollar index is down from 110 to 103 levels now. At that point of time, also the US yields, right, currently to 4.5%, see that it is moving closer to 4.2%. So some kind of an EM trade was possible, but at the same time, not all EM markets are going in a similar direction. Again, a lot of them are moving in a sporadic way. For example, if you say Jakarta index today, it's almost 4.5% down today within the emerging market itself. So very selective markets are up. There was a broader EM direction which was positive, but only some markets are doing relatively better.
Okay. What is the importance of dollar index? I know everybody talks about it, but the money could go to Europe, money could go to China, money could go to Japan. I mean, yesterday's sell figure was 4,000 crores. So dollar index is down, yet FIs are selling.
Absolutely. See, dollar index, if you see the weight of dollar index itself, 55% is indirectly the euro held, right? Then the Swedish krona and then the yen, like all three of them have different weights within the dollar index. So dollar index moving down is broader EM trade. That is the way, the risk of trade that is playing out. That is the way to look at it. The risk off and risk on is more of less directional with the DXY. That is why that EM versus DM, that is the trade call that happens with DXY. That is the way we look at it.
So in the near term, what could be the trigger for us? Could it be monsoon? Could it be earnings? Could it be oil? Could it be tariff? What are the next 2-3 triggers for the market?
On the conservative side, right? If we see the FI selling, right, almost 16% of the total index is held by FI today. The lowest that they've gone off till date is 13% back in 2004. So from 16% to 13%, that is 3% of our total market cap of $4 trillion. So almost $120 billion selling is still a potential, like the worst case scenario that we can talk about. But we've seen that at every $10 billion selling of FII, right? In October, we saw almost $78 billion that comes through. The market goes off down by 10%. So every $10 billion from year on selling moves the market down by 10%. Now, for the past 6 months, we are already down. Small cap, mid cap are more than 20% down. The broader market is almost 14 to 15% down. From year on, the valuations from fraud zone have come down to comfortable zone. So from year on, with 87, 88 rupees, your dollar index plus given the earnings visibility or the cuts possibility, we believe the intensity of FI selling will slow down from year on. The intensity will slow down. That is the way to look at it. We believe from year on, there won't be major gains. All the profit booking by FI that we've seen in the past 6 months, the intensity will cool off from year on. Incrementally, as you rightly mentioned, earnings visibility. See, currently we are close to 15 lakh crore of profitability for the NSE 500 companies, right? Within that, if we dissect for the 9-month basis, your broader index X of financials and X of commodities is actually moving by 14% of earnings growth for the last 9 months. So earning visibility for 12 to 15% for the broader market is still there. So the visibility, it will be one key trigger. Monsoon will be another kicker out there. Also, we're seeing some of the catalyst, right, beyond what we've seen on the budget side or even directly or indirectly the 8th pay commission, which is going to play out over the next 6 to 12 months. There are multiple factors that are going to play out. The whole question is, when will the FI selling stop, right? We believe that is going to be very soon. Intensity will slow down from here on. So that is the broader call that we are taking as of now.
Rahul, the one call that everyone's wondering about is whether to go all in into India right now, or do you think the year ahead is going to give us many opportunities to do that?
See, we'll have to be very selective from here on. From froth zone, we come down to a comfortable zone in terms of valuations. But are we in a deep value zone? The answer is no. We are not completely in a deep value zone. So selective pockets are very clearly visible where valuations are much more comfortable. So we'll have to be pure bottom up, look at the balance sheets over the next 2 to 3 years. How will these things shape up? How the earnings growth or the profitability of respective company is. So what we saw the momentum for the past 3 years, we believe that will not be back. It will be very sporadic. From here on, we'll have to be very, very selective in selecting the stocks for the respective portfolios or the strategies.
Good morning to you, Rahul. This is Shallo, so joining in the conversation. And like you said, you have to be very selective. We are not exactly in the deep value zone when you talk about the market, despite we've seen a sizable correction. So I wanted to understand where in the markets are you finding value right now, and which sector do you think looks attractive apart from banks?
Yeah, so beyond financials, we believe healthcare is going to do really well. Again, if you see the tail, right, a lot of these companies in the tail of not the larger pharma names, but the bottom ones on the tail side are doing selective very well. Some of the molecules that have been approved by the respective companies are actually going to bring very strong capability and the earnings visibility for the next 3 to 5 years, which these companies will be able to showcase. So we are selectively positive on the pharma names. Again, on the building material side, some of the names that we are seeing the trigger overall playing out over the next 2 years is very strong. Also, cement, we believe the consolidation in the next 6 months will play out. Also, the price growth that we are expecting in the cement sector will play out. The possibility of increasing royalties or at the mining level by state governments is happening, but that hangover will be there. But cement broader should do well over the next 2 years.
Do you see merit in going back to government-dominated stocks, as in their capex was down and they could come back?
It's going to be very challenging. I believe, see, if you see the budget, right, 11 lakh crore of total capital outlay, that was downgraded to 10.8 lakh crore for the last year. This year, again, they revised it to 11 lakh crore. But within that, if you see the sub-segments of the budget outlays, only power segment was the one which has shown higher growth, 14 to 15% of capital outlay in the budget. The other ones like roads, railways, defense were almost flattish on a year-on-year basis. So you have to be very selective. So we believe on the capital play or the capex play, power segment is going to do well. Within that, defense, roads, railways, you'll have to be very, very selective here.
Rahul, so I just wanted to understand, you did speak about the fact that the earnings growth will be a key catalyst for the markets going around here from here on. We've not seen great earnings for the last 2 to 3 quarters, and if you have to actually look at even Q4, the signals or the indications are not that bright as well. What's your take coming in the earnings growth, especially when we now step into the next FI, and what should one pencil in when you talk about earnings?
Right. So see, incrementally, Q on Q basis, right? At a Nifty level, we were 5% earnings growth for the market. Then we moved in Q3, we were closer to 8%, and Q4 possibly will move to 10 to 11%. So broadly, we are moving, touching the double digits now. Now, what has happened incrementally? A very interesting point here. In Q4 itself, because of the tariffs, a lot of these export-oriented companies have mentioned that they are doing very well because there is a bunch of the exports towards US. So a lot of companies in the US, right, because of the tariff war, they're trying to avoid any tariff-related disruption and have been loading up. So Q4 for the export-oriented sectors will be relatively better. But of course, in Q1, again, they'll cool off. Now, on a consistent basis, going forward for FY26, 11 to 15%, 11% for the large caps for the Nifty index and 15% for the broader index earnings is what is easily achievable. From here on, if we are penning in these numbers, probably the earnings cut will be relatively much lower from here
on. What is happening in the small and the mid cap space according to you? Do you see that this space has topped out for many years now? I mean, there are exceptions in any sector, but in general, do you think this clan, which is known as the small and mid cap clan, has that space, that pocket, has it peaked out for 2-3 years now?
See that momentum, right? I'll tell you a couple of things in my view which have played out, right? If you see 5 years back, the number of demat accounts from 3 crores moved to 17, 18 crores. So all the money that had to be flushed in for one particular point of time in the past 3 years was pushed into in the markets for whatever different reasons has happened. So that one time of re-rating for small caps and mid caps, the momentum that it created for across the market has played out very well. Now going forward, again, you have to be selective from your own balance sheets, your cash flows for the next 2 to 3 years, your earnings visibility, and the entry point of valuations. All these factors will play out from your own. So small cap, mid cap will do well if you are a good bottom-up stock picker, that will do well. But for momentum or the whole breadth of the basket that will play out, the answer is no. You have to be very selective from your own.
All right, Rahul, appreciate your time. Thank you very much for joining us.
If you like this video, then like, share and subscribe to ET Now.